We believe that it's not the job of the federal government to be micromanaging companies. And in fact, it's in the taxpayers' interest for the companies to have strong boards of directors and strong management. If the government were to interfere too much, we actually might reduce the potential value of those companies.
That was TARP Chief Herb Allison, who says the markets have stabilized, but it's still too soon to get rid of government assistance. This is Taking Stock. I'm John Ehrlichman, sitting in for Pim Fox. Allison's comments bring us to our next guest. Not all companies that go into financial crisis mode get help from the government. They call people like Mike Green at Tenex Capital Partners, a firm that specializes in bringing smaller and mid-sized companies back from the brink. Mike, thanks for joining us this evening. I probably don't have to ask you this question, are you busy right now? I'd rather ask you, is this the busiest you've ever been in your career?
It's not, believe it or not, the busiest we've ever been, but we are quite busy right now. This is, we were very busy in 02, 03, and believe it or not, all the way back in 92. We're very busy right now. This is a very different situation than past downturns that I've seen, but to answer your question, we're quite busy.
One of the things that we've seen occur over the last 6 months, let's say in public markets, equity markets, companies have been able to raise money through equity offerings. In the debt markets, money has been there. It feels like a lot of companies that were in distressed situations have battled their way back from that. In what you do, has that have things changed dramatically over the last 6 months? No.
My sector, the sectors we're in, or the situations, I should say, that we're in, will be the last ones to have access or availability to that type of cash.
The worst.
They don't, you know, they don't qualify for lending right now, and people don't want to put equity in a company where, I mean, it looks like the debt on top of them is having a tough time. So they'll come back last, but the only way for them is to really start improving their performance and improving their operations so that they do qualify, even if expensive debt, for some amount of debt, and then eventually some equity.
When you look at these situations and you say, here's a situation where I think they can turn it around, what are you looking for? Say, M&A, we're talking a lot about mergers and acquisitions right now. Do you say, well, there's a business they could sell in this market at a better price than they could have a year ago?
Yeah, I think that's a good, that's one, I mean, you know, the old Jack Welch line from many years ago of fix, close, or sell is something that we still remember. Obviously, you try to fix things, not close them, and sometimes when you fix it, you create some options or option preservation, and there's the opportunity to sell. But what's most important is many of the companies that we see that are distressed, their situation is attenuated by the fact that they experienced recent rapid growth prior to a downturn. And with rapid growth, you have to extend yourself in credit lines, in new markets, new products, add people, add staff, add factories, and then when the capacity all of a sudden is too big for the demand, they're carrying all this extra weight. So one of the best ways back to health is to get yourself back to what you did very effectively before you grew, and that's where you create options for these companies.
So let's take a step back. What is the first question you ask when you look at one of these companies and determine whether or not you can save them?
Well, it really depends as to how far into the cycle they are, and believe it or not, it's not always a business question. It's a question of, is the leadership ready? Are they open-minded? Are they willing to try to do something outside of bankruptcy to try to comprehensively and in a way that's consensual improve this company's performance? Many people right away try to run to the balance sheet to repair a company, which is really not a long-term effective solution. Some companies can't survive the trauma of going into bankruptcy, and you try to do it consensually outside first and make sure the people are ready for the shrinkage that must take place.
Are we through the peak in bankruptcies, or are we not even there yet?
I can't answer that question directly. I think the liquidity situation has loosened up a little bit for the companies that we deal with that couldn't even make it to bankruptcy because there was no liquidity or financing. You need money. One of the secrets is you need money to get into bankruptcy. You need availability. And if you have no assets left to pledge, it's hard to get what's called the DIP financing or the debtor in possession financing in bankruptcy. So some people didn't have that option. I would say that it's hard to say, at least in the U.S., whether at the end. In Canada, it's improved dramatically. Other countries didn't have the bankruptcy or reorganization options that we've always had in the U.S., where you can really get some protection from your creditors and reorganize at the other end. And what's happened over the last few years is our situation has deteriorated a bit, where people were slipping into the Chapter 7 instead of 11 because the liquidity situation we had did not avail people of the opportunity to fix themselves.
So you gave us a little bit on geography, U.S., Canada. What about sectors? Where are you seeing the most distressed businesses on a sector-by-sector basis?
That's a good question again, John, and it's not always the way we look at it. The situational aspect of it comes across many sectors where people have high fixed costs, the old story, with little flexibility. Many times it's industrial-type companies in the old economy with bargain units in there and unions, large pension obligations, a lot of factories, facilities, trucks, aircraft, things that are expensive that have high operating leverage, which are very, very good for you in good times. You make a lot of profit when you're full, but in down times, you get the reverse effect with high operating leverage and it drains cash. So we've seen those people get hit the hardest.
If we come back to the average investor, someone who, say, invested in the stock of a company that seemed like it was headed for bankruptcy 5 months ago and has now seen this stock take off, what is something you can look at on the balance sheet to say whether or not should I stay with this stock?
Well, I think you'd look at, if you want to go into some details, you need to look at the traditional structure of the balance sheet and the capital structure. If the stock has grown, have you seen similar growth in the value of the other parts of the capital structure? For instance, if the debt were trading, if it was public debt, and that was at a discount similar to the stock was, has the debt risen in value as well? So you have that nice balance in the capital structure that all classes are participating equally. I think what you really need to do, though, is we always try to strip away everything we can to get down to the cash characteristics. Is this company generating or burning cash from operations? Not liquidity, not availability. From the pure operations, are you creating or are you destroying cash? And that's the fundamental aspect that we look at to see what the future will look like for these distressed companies.
Well, it sounds like you're going to stay pretty busy for the next little while.
I think we will, unfortunately, but I think we're getting ready to turn the corner.
All right. Mike Green of Tenex Capital Management, we appreciate your time this evening.